Okay, class, I just did a video on the effective interest rate calculated used under the example of a discount. Now we're going to do the same thing, but in this case it's going to be at a premium instead of a discount, all right? So, my example is going to be the same. We've got bonds, $100,000 worth of bonds that this corporation is going to be selling, okay? These bonds are 4-year bonds. They're going to pay interest annually, and the contract rate is 10%. Once again, the contract rate can also be called the coupon rate, the stated rate, or the discount rate, or not the discount rate, or the nominal rate. So the coupon, stated, or nominal rate. Okay, I'm going to call it the contract rate because that's what my textbook uses. The market rate right now is 8%. So when the contract rate is 10%, but a bond at this risk level would normally sell at 8%, then this bond's going to sell at a premium, okay? Because it's paying out interest at a higher rate. So it's going to sell above the $100,000, okay? But we're going to see that really these investors are only going to earn 8% and not 10% on these bonds, okay? So let's do this timeline again. Let's value what these bonds are going to sell for. So first of all, we've got to look at the cash flows. The cash flows are the interest and then what it's going to pay out at the end, the $100,000. So the interest is calculated by taking the contract rate, or you may be using coupon, stated, or nominal rate, taking this contract rate of 10% times the $100,000. So the corporation will pay out $10,000 cash every year for 4 years. So that's what my timeline's doing. Year 1, year 2, year 3, year 4. And then it will also pay back the full bond amount of $100,000 at the end. So this right here is my cash flow. So let's calculate what this is worth today, year 0. Okay? The annuity, this is an annuity, $10,000, it's 4 payments, equal time periods apart. So equal amounts, equal time periods apart is an annuity. So we'll go to our tables. It's the present value of an annuity, the interest rate will be the 8%, because that's what this is going to earn. It's going to sell at the 8% amount. Even though it's paying out at 10%, it's paying cash-wise 10%. People are only going to earn 8% on this. So we're going to use interest at 8, and then the N, number of periods, is going to be 4 periods. Okay? So when we go to the table, our present value of an annuity table, it's going to be 3.3121. So that's 3.3121. So then times 10,000 is 33,121. Okay, now we're going to discount the single dollar amount, the 100,000, back to the present. Okay, so we're going to go to the present value of a single dollar amount table. It's a different table. Present value of a single dollar amount. It's going to be 4 periods out, because it's out in year 4 that it's going to get paid. The interest rate we'll use is 8%. It's the same periods and interest rate that we used previously for the annuity, except we're going to use the present value of a single amount table. So we're going to take the 100,000 times, let's see, 7.7350. So that gets us 73,500. So then the value of our bonds is going to be 106,621. Okay, that's the value of our bonds. Okay, they're going to sell at a premium. People are going to be willing to pay this amount for them at year 0 to be able to get these cash flows in the future. And what they'll be earning, see, they'll be getting these paid out at 10%, calculated at 10%. But what they're going to be earning is only 8% because they're paying more than what they're going to get at the end. Okay, so this is going to be used up. This premium is going to be used up as we calculate interest, which we're going to see in just a second. All right. So anyway, our original journal entry is going to be cash coming in for the corporation. Cash coming in of 106,621, and then premium. I'm abbreviating here. Premium on the bonds payable. Premium on the bonds payable is 6,621. The premium's recorded as a credit. And then we've got our bonds payable. Okay, and that's 100,000. All right, our bonds payable is 100,000. So premium on the bond payable 6621 and our bonds payable 100,000. So these two go together on our balance sheet, showing that that they paid this amount for the bonds. Okay. So this is what will be recorded on January 1st, 2015, when we sold the bonds. Okay. So January 1st is when we sold the bonds. So this is what will be recorded. Now what we're going to do, I'm going to erase all this. You may want to write this stuff down. It'll be easier and make more sense as we go through this next part, but I need the board, so that's why I'm erasing all of this. Okay, so now we've got our cash payment. I'm going to put together, I'm abbreviating some stuff here, cash payment, bond interest expense, the premium amortization, the unamortized premium, and then our final carrying value of the bond, so our carrying value. All right, so now on January 1st, and I'm using the year 2015, on January 1st, the value of our bond that we calculated was $106,621. That's what we calculated in the timeline, was $106,621. So the premium amount of this that has not been amortized yet is the $6,621. Okay, it's the amount over $100,000. Now on December 31st, 15. We're going to have our first interest payment. Okay. Now remember, the cash amount is the bond amount here, 100,000 times our contract rate. So that's going to be $10,000. Okay. But our actual interest expense is the market rate, because that's how we calculated the value of this bond. So it's the 8%. So I like to put 8% right here, so it reminds me that's what I'm using. Okay. You always use the market rate, whether you're doing a premium or a discount. You calculate the bond interest expense using the market rate. So we're going to take 8% of the current carrying value, $106,621, and that gets us, excuse me, $8,530. Okay, 0.08 times 106,621 is 8,531. So that means that we need to use up 1,470. Okay, so you just subtract the 6,621 from the 8,530 to get 1,470. So this is being used up 5,151. That's how much that was reduced by. Okay, the 1,470 is what we're reducing this by. Right, and I said this wrong. Okay, let me back up now. We got this by taking the 10,000 minus the 8,530 gets us 1,470. That's how much we're reducing this by, 5,151. So then our carrying amount is 105,151. There we go. Okay. So we got this just by adding the bond value, the bond value at the end, the $100,000, the principal amount. To get 105,151. Now on December 31st of the next year, 2016, the cash payment is $10,000. The interest expense is 8% times our carrying value. Our new carrying value is 105,151, which gets us 8,412. The difference between this and the 10,000 is 1,588. Okay, so that's how much we're going to decrease this by. So our premium's gone down 1,588. So we're going to decrease this down to 3,563. Okay, so now our new ending balance is 103,563. We take this plus the 100,000, gives us 103,563. Now the next year, we just keep going through the same process. $10,000 cash. 8% times the 103,563 gets us 8,285. 10,000 minus 8,285 gets us 1,715. We reduce our premium by that, which gets us 1,848. And now our, 101,848. 1848 is now our new carrying amount because we add this to 100,000 to get our carrying value. And now we're at the end. This is the 4th year. Cash payment is 10,000. 8% of the 101,848 is approximately 8,152. We have to round here because we have to use up the remaining amount of this discount, of this premium, I'm sorry, which is going to be 1848, okay? We have to use this up, so this is going to have to be 8,152. So usually your last year, you just force this to work because oftentimes if you're using the tables to calculate the value, you're going to have rounding errors, all right? So anyway, now that we've used 1848 here, that's 0, and this is now at 100,000, okay? Now, let me just show you what our journal entry would be. I already showed you the journal entry here for when the bonds are sold, all right? Let me show you the journal entry on December 31st, 15. Okay, on December 31st, I'm going to squeeze this in. On December 31st, we would have bond interest expense of the 8,530. So we'll debit 8,530. And then we've got our premium on bond payables of, let's see, 1,470. That's how much we're using up of the premium. Okay, because remember the premium has a credit balance, so we're using up part of this. And then the actual cash that's going to get paid to these investors of the bonds, the buyers of the bonds, is going to be 10,000. So cash of 10,000 will go out of the corporation. We have this much expense, and this is how much we're using of the premium. And that's why the premium then goes from 6,621 down to 5,151 because we're using up part of it on our interest payment. Okay? All right, this is confusing, I know. So you got to keep going through this over and over again because it does make sense. It makes sense, you just got to get it into your brain. So in the next year, you're going to have a very similar journal entry. It's going to look, you're going to use these same accounts. You'll have bond interest expense in 2016 of 8,412. The premium used up, the amortization is going to be 1,588, and the cash will still be 10,000. The cash is what's always paid out, 10,000. Okay? And this is what your bond interest expense is going to be, which we already have, and then the amortization of the premium on the bond payable being used up. All right? All right, class, good luck.